So you finally got some surplus money in your budget and now you're wondering, should I use it to pay off my mortgage extra fast or should I use it to build up my superannuation? In my 30 years of financial advising and now financial coaching, this is easily one of the biggest decisions your average Australian will have to face at some point in their financial journey. Get it right and you buy yourself peace of mind and a strong financial future. So in this video, I'm going to share with you a very simple framework that will help you make this decision with absolute confidence. First, we're going to have a look at the numbers and then we're going to look at the more practical aspects of making this decision that most people seem to ignore. So if after watching this video you'd like to learn a little bit more about how salary sacrificing to superannuation actually works, then check out the link in the description where you'll find a free training on how salary sacrifice actually works. So let's get stuck into it. Mortgage versus superannuation. Where should I be putting my money? This is the agenda. Firstly, we're going to look at using a very simple framework to compare the numbers. So that means we need to know, well, what interest rate are you paying on your mortgage? We need to know what are the expected returns on your superannuation. We'll then have a look at the tax benefits and implications of each of the strategies. We're going to have a look at a very simple case study that will allow us to pull it all together, and then we're going to look at how to apply this framework to your situation. Okay, so let's meet Marcus. Now, Marcus is a 45-year-old bus driver currently earning around $95,000 per annum, which happens to be the average Australian income for someone between the age of 40 and 45 years old. He has a home loan rate of around 5%. The return on his superannuation is approximately 7%, or the expected return, given that he is in a growth fund in his superannuation. His employer does allow its employees and Marcus to salary sacrifice to superannuation. And again, if you're not quite sure what salary sacrifice is, can I encourage you to check out the link to the free training in the description where I take you through what superannuation is and how it works. And most importantly, Marcus and his wife, due to the fact that the kids have finally finished school, now have approximately $1,000 per month surplus cash flow that they're looking to do something with. So let's look at the first option for Marcus, and that is to pay down the mortgage faster. Now we know that Marcus has an extra $1,000 per month, which equates to $12,000 per year. We know that the interest rate on the mortgage is 5%, so 5% times $12,000 paid off the mortgage means that we should be able to save around $600 in year number one. Now, it won't be quite $600 because we're putting $1,000 aside each month, not $12,000 up front, but let's just use $600 overall as the saving. The important thing to note here too is that it's guaranteed and it is tax-free. Now, it's guaranteed because we know the rate on the mortgage. Unlike investment returns, we never quite know what we're going to get. With the mortgage, we know that it's 5%. Now, we also know that it's going to be tax-free because money saved on paying down our mortgage is not taxable. So we haven't earned it, we've saved it, so we don't have to pay tax on it. So if we look at the pros and cons now of putting more money into your mortgage, the first pro is that it's a guaranteed return. We know that that's a return we're going to get. We also know that it's tax-free because we're saving it and not earning it. We know that it's going to give us peace of mind because we love seeing our mortgage go down a bit faster. And it gives us greater flexibility because if we needed to, we could potentially pull that out from our redraw facility or our offset account, wherever we put it, if we needed something in an emergency. It gives us far greater flexibility. So let's have a look at the cons. Well, firstly, it's potentially lower returns. Paying down your home loan, we know we're going to get a 5% return because that's what the home loan rates are right now. But potentially we could have got a lot higher had we put it somewhere else. It's not tax deductible. And of course, there's a missed opportunity not putting the money into superannuation. We're not getting those compounding returns over time. So if we have a look at option number 2 now, that is paying more money to superannuation via salary sacrifice. Now, salary sacrifice means we're putting it in there pre-tax. So Marcus's savings right now, after tax, is $12,000. But if we look at it before tax, that number is actually $17,143 that Marcus gets to put into superannuation. Now, there is a thing called contributions tax. So when you put money into superannuation pre-tax, you then pay contributions tax at 15%, which is a lot less than most people's marginal tax rate, and that's certainly 15% lower than Marcus's marginal tax rate. So he has to pay $2,571 of that money there, which leaves him with $14,572 in his super fund. So that's there to grow and compound over time. Now, we talked before about Marcus having a return in his superannuation of 7% because he's in a growth option, but that 7% will come from either capital growth, the value of his investments going up, or it'll come from the income that those investments create. So that could be dividends from the shares in his fund. It could be interest earned on cash and bonds and those sorts of things, fixed interest in the fund as well. So I've split it up so that the income that he's earning is 4% and the capital growth is 3%. This is important because you do have to pay income tax in the fund on the earnings. So that means that after the income tax of 15%, Marcus gets to keep $496 of the $583 return. And assuming that none of the investments got sold, then there's a capital growth of 3%, which is $437. So if we add those two together, the total return for the year is $933, which is a lot more than the $600 that we could see just by saving money paying down the mortgage. Now, if we have a look at the pros and cons, though, of salary sacrifice into super. Firstly, the pros: higher long-term potential returns. So we've used figures here of a 5% saving on the mortgage or interest rate on the mortgage and 7% return on the superannuation. That 2% over the years compounds significantly. It's tax effective because we can contribute to super pre-tax, and the income tax and the capital gains tax on the money inside superannuation is also a lot less than what you would pay as income tax or capital gains tax outside superannuation. Also, compounding returns. The money that you're not losing due to tax stays in the fund and then can compound and grow over time, and that is very significant. But let's have a look at the cons. Firstly, the returns aren't guaranteed. We all know that the investment markets can go up and down significantly. For those of you that survived the global financial crisis in 2007 to 2009, I was managing hundreds of millions of dollars in clients' money during that time. It was a very scary period of time. Returns aren't guaranteed. We all understand this. So yes, we've used 7% as a long-term average, and I think that's quite doable, but you never know. Also, your funds are locked away until retirement. So typically age 60 at retirement, or 65 if you're not retired, if you're not choosing retirement date. So they're locked away for a very, very long time, which means you've got very little flexibility with that. So let's have a look at the two options now side by side. So what we've got here is option 1, pay off the mortgage. Option 2, salary sacrifice to superannuation. In both cases, the before tax savings are $17,143, but after tax it looks quite different. For Marcus to have $1,000 per month in savings, he pays 30% tax on that and gets to keep $12,000. Whereas when we salary sacrifice, we don't pay any income tax, but there is a 15% contributions tax, which means that we're left with more when we salary sacrifice to superannuation. So if we have a look at the returns, we know that when we pay off the mortgage, we've got a guaranteed 5% or whatever your home loan rate is at the time. Whereas with the superannuation, of course, we have investments in there that can fluctuate in value significantly. We've assumed a long-term interest rate of 7% there. Got the little asterisk there just saying this is a long-term average return. Some years it will be a lot higher, some years it will be a lot lower. That is the average. And then after tax returns, you can see what we've got is around $600 is what we expect as a savings by putting $1,000 per month in a mortgage at 5%, whereas the investment returns are around $933 for the superannuation. So that's purely looking at the numbers. However, anything financial is never just about the numbers. There's a number of other components that we need to take into account. So let's start by having a look at the financial considerations. Firstly, what are home loan rates? What rate is your mortgage right now? A few years ago, they were less than 2%. You can imagine that 2% paying extra money off the mortgage isn't going to save you a whole lot of money. You're probably better off in low interest rate situations putting more money into your superannuation. Equally, when interest rates are high, it might actually make more sense to pay more off your home loan. We want to have a look at the structure of your home loan as well. Is it fixed or is it variable? If your home loan is fixed at the moment, chances are there are some limitations on how much you can pay your home loan down by. Often the banks will say when you've got a fixed rate, the most you can pay off your home loan in advance is around $10,000 a year. It could be very different for your home loan, but the important thing is that you know what it is for you. You want to have a look at your tax rate. If you're not earning a whole lot of money and if you're in a low tax bracket, it might not make sense for you to pay extra money into superannuation. If you've got a high income and you're in a high tax bracket, it might be an extra incentive to pay extra money to superannuation to save yourself tax. There are a few nuances around this though. If you're earning too much, you could get slugged with an extra tax. So just be aware of that. And again, check out my salary sacrifice video and training because that will help you understand that a little bit better. And then we've got contributions caps. So I don't want to get too technical here, but you are limited to how much you can actually put into superannuation via salary sacrifice each year. Right now, as of the 25-26 financial year, the maximum that you can contribute as a concessional contribution. Now, concessional is your employer contributions on your behalf plus any salary sacrifice you put together. Those two combined can only be $30,000. So you may find that you're limited in terms of how much you can put of your savings into superannuation. So make sure you check that out as well. Okay, so they're the financial considerations, but the world isn't just about numbers. So other things to consider are your mindset and your comfort around debt. I've met people that have tens of millions of dollars in debt and it does not stress them at all. I've equally met people that have $5,000 in debt and they're stressed to the eyeballs. Personally, I don't like debt. My wife and I were really intentional about getting our home loan paid off extra fast, and that has brought us a huge amount of peace, a huge amount of joy and flexibility in life. So you've got to decide what's best for you. Then, of course, flexibility and access to funds. When you put money into superannuation, it is locked up until you hit 60 and retired, or 65. So depending on where you are in relation to age 60 and 65, that may or may not be a big deal, but it does mean that money's locked up. Whereas if you put money into an offset account or into a redraw facility, you can access that money should something come up. Then stage of life, where are you at? Are you close to retirement? Are you a long way away from retirement? Do you have big life goals planned? Only you can decide that, but think about it in terms of your stage of life, and is it better to have the flexibility of paying down the mortgage? Or is it, no, retirement's looming, I need to be putting that money aside now. So other considerations, these are equally weighted with the financial considerations and only you can make the decision, but it is certainly worth discussing and working through what's the best option for you. And remember, it doesn't have to be one or the other. Okay, it's not black and white. You either salary sacrifice or you pay money off the mortgage. You could go 50-50 or any other combination in between. Sometimes I think we get so stuck on one or the other and we forget that actually it could be a bit of both. So do what fits your situation best. Now, I hope that this has been helpful. If it has, please click the like button because that helps my channel reach more people, help more people with these basics of finance. And please subscribe because every week I release more videos with practical, no fluff money strategies that will help you and your family thrive financially. Now, let's sum things up. Firstly, both options have their pros and cons. There isn't a right and wrong. Secondly, it depends on your financial goals, risk tolerance, age, and stage of life. So go through those factors, those considerations we looked at the end, and think about where you sit in the overall equation. Know your numbers is really important. Know what your interest rate is. Know what the returns on your superannuation have been. Know how much you've actually got savings capacity each month. Make sure that you've got a cash reserve set aside so that you can feel comfort in whichever decision that you make. And please remember, it doesn't have to be one or the other. It can be a combination, 50% to mortgage, 50% to superannuation, or any combination in between. The important thing in all of this is please just take action. One of the reasons that I love what I do now as a financial coach is sitting down with people, helping them set a plan, and then helping them take action. Because often we think about these things, we think about these things, we think about these things, and we never do anything about it. So please don't let that be you. Take action. There isn't a right, there isn't a wrong. Do what feels best for you in this situation and just get started. So thank you so much for watching this video. I genuinely hope that it's been helpful. If it has, please click the like and subscribe. And if you would like to learn more about how salary sacrifice actually works, check out the link in the description to my free training on salary sacrifice. And please remember that it is the little habits and strategies that you put into place today that can literally make $1 million difference to your future. Take care, and I look forward to seeing you in the next video.